Everybody, welcome to our discussion on this topic, which is hedge accounting. Friends, we understand the relevance of a cash flows hedge with respect to, for example, a hedged forecast transaction. Now, the whole perspective is that I've entered into a contract today, probably to buy or sell something in future, and I have tried to fix the price of that particular value, the price of which it is exposed to IM, or the price to which I am exposed to, just to clarify. Right. Now, importantly, when I say that I'm yet to get to that settlement date, I'm yet to, let's say, purchase that inventory or purchase that machine, or let's say, buy those goods, then till the time that that purchase has happened, that settlement has happened, there is still a change in the value of my contract, right? The derivative or the hedging instrument there. So how do I look at that change? We understand in a cash flows hedge, we keep the reserves to the other comprehensive income. We don't bring the volatility into the P&L, but eventually what happens? That's what we want to talk about with the help of a particular example. And then let's see what the standard has to suggest in its technical jargon. Okay, we are given a scenario where we're saying that there is a hedge forecast transaction by done by an entity. There is a futures contract date. So there is a contract which is entered into on 15th of October 18. The settlement date is 15th of January 19. So okay to assume that there would be a reporting date midway, right? The futures rate is given as $80 per unit. So there could be some units that an entity is thinking of purchasing. So we are looking at a purchase here. The contract size is 20,000 units. All right. So effectively the exposure comes at $80 for 20,000 units. The future price are given at two different dates. One is the reporting date, which is 31st of December 18, which is $85 a unit, and 15th of January 19, which is my date of settlement. That rate is given as 84.50. Now, essentially, when I look at this given information on the date of my contract, assuming there is no premium paid, okay, on the date of this contract, what we need to do is basically 15th of October 18, we do not do any entry here, right? We haven't really paid anything so far, but when I come to 31st of December 18, assume this is a purchase and I'm exposed to, so that's where the entire calculation we want to discuss. I'm exposed to the purchase price. It might increase, so I fixed it at $80 per unit, and essentially my fear came true, that on 31st of December 18, the contract could have only been entered at $85 per unit. That means essentially this futures result into a $5 gain per unit. So what do? I create the futures asset. So I call it a derivative asset to the extent of 20,000 into 85 minus 80, which effectively is $100,000, right? Now settlement is yet far, so we simply take this in other comprehensive income here. Straightforward? Yep. I come to my next date, which is 15th of January 19. This happens to be my settlement date, and so you observe that the contract value has declined. It has gone to 84.5 from 85, so I need to book that 50 cents loss for each unit. That's what I'm supposed to do here. So what do? I simply reverse this transaction, debit OCI, which is 20,000 is the number of units, into 85 minus 84.50. So that makes it $10,000 credit derivative asset to the extent of $10,000. So essentially it means that in my books I have a derivative asset of $90,000. Okay, At this point in time, of course, the settlement has taken place. So I'm saying on the same date, 15th of January 19, this derivative asset would be settled. It comes to maturity. So we do the first transaction, credit derivative asset to the extent of $90,000. Effectively, I am receiving money against this derivative asset. So I can say I have received $90,000 in the settlement of this contract. Okay, but the job doesn't end there, because I'm essentially purchasing inventory, which ideally should be at 84.5 per unit, which is 84.50 into 20,000. That should give me $1.69 million. Okay, that's the cost of inventory. But against this cost, there is an OCI gain to the extent of 90,000 sitting in my books. Okay, so what we say here is that we first bring that OCI gain as a reversal. It's sitting in the credit of 100 minus 10, so that is reversed 90, and the balance amount, of course, is the cost of my inventory, which is 1.6 million here, right? Essentially, I'm paying 1690 here as well. So you shall observe that my out of pocket exposure is 90 positive and 1690 negative, essentially 1.6 million or 16 lakhs here. That is the cost of my inventory. So what does it all mean? We are simply saying that, look, essentially I'm only going to pay $80 per unit, right? But this contract in itself could be an asset or a liability for me until the settlement has taken place. So what shall I do? I should be looking for the movements in the value of this contract, park it in the other comprehensive income till the time the settlement happens. And once that settlement happens, since I'm procuring inventory, effectively the cost of my inventory should be taken at the rate at which it has been closed. Okay, which means all the gain sitting in my OCI, instead of being thrown into the P&L, we bring it against the value of this inventory. So this 90 is adjusted against the value of the inventory. What if it were a machine? It's exactly the same treatment, and that is what my standard is trying to tell me, that the amount that has been accumulated in the cash flow hedge reserve shall be accounted for. If a hedged forecast transaction subsequently results in recognition of a non-financial asset or a non-financial liability, the entity shall remove that amount from the cash flow hedge reserve and include it directly in the initial cost or carrying amount of that asset or liability, right? So that is how you do the accounting for these kind of transactions, where there's a cash flow hedge in place, there's a non-financial asset or a liability on which you have an exposure. You need to bring those amounts into the value of those assets and liabilities, and it is not a reclassification adjustment under hedge accounting. Looks okay so far. So that's it from my side. Thank you very much. Good day and take care. Bye-bye.